Hey there, and welcome to today's Explainer. Today, we are talking about something truly powerful. I mean, we've all been there, right? Staring at a messy, endless spreadsheet of financial data and just feeling completely overwhelmed. But what if you could take all that chaos and transform it into brilliant, actionable insights using just a few lines of Python? Well, let's dive right in and explore exactly how you can take total control of your financial data, moving from simple transaction tracking all the way up to advanced portfolio optimization. So think about this for a second. What if you could literally code your own personal hedge fund? Now, I know it sounds like something only Wall Street quants with supercomputers can do, but with modern Python libraries, that kind of power is right at your fingertips. In this explainer, we're going to take a crawl, walk, run journey. Think of it kind of like driving. Crawling is looking in your rearview mirror at your past spending. Walking is looking out the side window at current market trends. And running, well, that's looking straight at the horizon, predicting and optimizing your future wealth. Here is our roadmap for today. We'll start with Python meets finance, move on to tracking transactions with Dash, then reading the market, dive into modern portfolio theory, and finally, optimizing your wealth. Let's jump right in. Section 1. Python meets finance, the crawl, walk, run journey. Section 2. Tracking transactions with Dash, the crawl phase. Okay, before we even think about conquering the stock market, we really need to understand what's going on in our own wallets, right? Using a pretty brilliant methodology from the developer Argent Codes, we're going to build a personal dashboard, and it honestly just takes 4 clear steps. First up, we load our raw CSV transaction data using pandas. Second, we process those dates to extract specific years and months for our user interface filters. Third, we pass this nicely structured data straight to the layout. And finally, we render our interactive charts. It's a super clean pipeline that turns a static, boring file into a living application. Now, the real magic here, it's the interactivity. By wiring up some Python callbacks, we get these amazing interactive year and month dropdowns right alongside categorical filtering. So imagine selecting 2024 and groceries and instantly seeing your bar charts auto-update and your pie charts respond on the fly. You aren't just looking at data anymore, you are effortlessly slicing it to spot your own personal spending trends. It's a total game changer. Section 3. Reading the market, the walk phase. All right, so once your personal finances are neatly visualized, it's time to look out the window at broader market trends using Matplotlib. Now, when most people look at stock data, they just use standard line charts. But the problem is, line charts only show the closing price. They completely miss all the intraday context. Candlestick charts, on the other hand, reveal the true price volatility that happened while the market was actually open. And for any serious financial analysis, visualizing that volatility is absolutely crucial. And that brings us to a totally foundational term in finance. You've probably heard it, OHLCV. It stands for open, high, low, close, and volume. These are the 5 critical data points of literally any trading day. And the best part? Python makes grabbing this data an absolute breeze. By using a package like yFinance, you can download years of historical OHLCV data for any stock in a matter of seconds, formatting it perfectly for our candlestick charts. So if you look at the anatomy of a candlestick, it basically tells a complete story in just a single glance. The solid body shows the range between the opening and closing price. Those wicks poking out on the top and bottom, they show the extreme range, from the very highest to the very lowest price of the day. The color gives you the immediate vibe of the market, green for a day that closed up, red for down. And when you pair that with a lower panel showing the trading volume, you instantly understand the actual conviction behind the price movement. Section 4. Modern portfolio theory, the run phase. Okay, you've tracked your spending, you visualized market volatility. Now we finally graduate to the run phase. Modern portfolio theory. Developed by Nobel laureate Harry Markowitz, the core idea here is that an investment's risk shouldn't just be viewed in isolation, but by how it impacts your entire portfolio. To actually apply this, we start with raw historical data for a sample portfolio. Think big names, Apple, Nike, Google, and Amazon. Using Python, we calculate daily percentage returns and something called a covariance matrix, which basically tells us exactly how these stocks move in relation to one another. Next, we use that covariance matrix to actually power our algorithm. Now, don't let the math intimidate you. This equation represents one of the main objective functions of modern portfolio theory, and the goal is beautifully simple. We're essentially asking Python to mathematically maximize our expected returns for a given fixed level of risk. We want the algorithm to just shuffle our stock weights around until it finds the absolute highest return possible without taking on any extra volatility. Or, actually, you can totally flip the objective around. The mathematical goal here becomes minimizing our portfolio's overall risk for a specific target return. Let's say you know you need a 10% return to reach your retirement goals. Well, Python is going to crunch the numbers to find the exact combination of Apple, Nike, Google, and Amazon that hits that 10% target while exposing you to the lowest possible amount of market swings. Section 5. Optimizing your wealth. Visualizing the efficient frontier. So to actually find these optimal asset combinations, we run what's called a Monte Carlo simulation. We basically command Python to just go crazy and generate tens of thousands of random asset weight allocations, testing every possible mix you could imagine. Plotting all those random portfolios creates this massive scatter plot of dots. And that sweeping curve forming the left and top edge of the mass, that is the efficient frontier. Any portfolio landing exactly on that outer edge represents the absolute best possible return for that specific risk level. Anything inside the curve is, well, mathematically suboptimal. Out of all that, how do we pick the single best point on that entire curve? Well, we use the Sharpe ratio. This metric measures the average return earned in excess of the risk-free rate per unit of volatility. Essentially, it calculates exactly how much extra return you're getting for the extra stress you're taking on. And by using Python's ID max function, we instantly pinpoint the single portfolio in our entire simulation with the highest Sharpe ratio. Boom, that is your mathematically optimal portfolio. Wow, we've really covered a tremendous amount of ground today. We crawled by building interactive dashboards to track our cash flow. We walked by extracting OHLCV data to analyze market psychology. And we ran by simulating thousands of portfolios to pinpoint the efficient frontier. So, I want to leave you with a provocative question. Now that you have the blueprint, how will you optimize your own financial data? The tools are open source, the data is out there, and the Python code is just waiting for you. Get out there and start building. Thanks for joining me on this explainer, and keep learning.